All right, well, things weren't looking so hot earlier today, but by the end of the day, we kind of rallied into the close. Not so bad, right? It could have been worse. I know that sounds like it's a campaign theme, but re-election campaign theme. But it could have been worse by the end of the day today. The markets weren't nearly as bad. But they're also not bullish either. And if we haven't learned our lesson from earlier in the week about why stocks rally when we are below moving averages, then we'll probably learn it here again by the end of this week and see what happens next. So we're going to break down what I expect will happen next week coming out of the holiday in today's video. We also take a look at some really significant long-term moves that are occurring across different asset classes. So our intermarket relationship discussion is a really long one today. So it's a long video for that reason. But there's some fascinating patterns that you want to check out. We also take a look at today's trade idea on a stock that's breaking down itself and talk about how to trade that with a little bit different setup. So let's go ahead and get started. Today is Friday, January the 14th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the market forecast indicator first, as always. As you can see, a nice little rally here to close the day. In fact, we actually ended up positive on the day. Barely, just under 4 points, but that's good enough, right? It was not good enough to keep the intermediate line from dropping into neutral territory, so it's continued to fall, now back below the 60th percentile. Market sentiment's falling. I mean, that's hard. That's more of a really weak bearish, because you're still essentially in bullish territory, even if you're just a smidgen below it on the intermediate line. You're just barely below the moving average. It's actually still rising. So you have light pink shading and a red line. Market sentiment was at an extreme low when we were at the lows of the day. Really big rally, brought the near-term line not out of bearish territory, but at least out of the reversal zone, and brought the momentum line from being into extreme lows itself. So really, really good close today for the S&P 500. Better than it could have. It could have been a lot worse. Not that it was a bullish close, but at least it wasn't as nearly as bearish of a close as it could have been. The intermediate line for the Nasdaq is still in bearish territory here. Remember, the S&P is just barely below 60th percentile. Market sentiment line is falling. It's almost out of bullish territory too. So not as bullish as the S&P. Excuse me. The Dow Jones Industrial Average, you can see its intermediate line is actually still well in the bullish territory. So this is by far the most bullish. The near-term line is also out of bullish territory after not really forming a bullish peak here, a lower high point. And as of right now, trying to form a lower low point with another lower shadow there. And then finally the Russell 2000 ended up with a positive day too, a little bit of a hammer pattern again. We saw that on Monday. We kind of bookended the week with a hammer pattern on Monday and a hammer pattern on Friday. The hammer on Monday lasted a day, and then we rolled back over, and we'll see how long this hammer pattern lasts. Near-term line again after a failed bullish near-term peak is coming down to what may be a lower near-term low point. It looks like a little bit of a divergence starting. This was also at extreme lows. Both these lines were below the 5th percentile at the lows of the day. So very significant rally to close the day to get back up above yesterday's low point. And not quite getting above last week's low point, but at least back above yesterday's low. So not nearly as bearish, still 2% below. Dark pink shading and a red line, but not as bad as it could have been. In fact, if you notice, the intermediate line actually closed above the market sentiment line again. They're both kind of right on top of each other, but really, really good close there. So now let's go back to the S&P and take a look at the market forecast on a weekly chart. So give me 1 second to do that. And you notice again, coming off a cluster 2 weeks ago, with a little bit of a bearish week last week, and then a big time doji pattern this week. The intermediate line still easily up above 80, so we're nowhere near being too bullish or bearish at all really there. The near-term line is dropping. It's dropped out of bullish territory. This was a very weak near-term run so far at least, and we're not in bullish or bearish territory yet thanks to the close off of the lows. 1 week after the momentum line dropping below the 5th percentile, we're still in bearish territory in the momentum line. So not as good of a reversal as we would like to have seen. The near-term line for the Nasdaq did drop in the bearish territory. And the intermediate line is dropping below 80. So in fact, it's the lowest intermediate drop that we've had since earlier this year in February and March. Was the last time we got pink shading here, and then a brief pink shading back in September and October of last year. a lot closer to the moving average this go around than we were either of these other times, right? That we had the pink shading here. Bigger, more of a convergence forming here too. The Russell 2000 obviously doesn't just have light pink shading, it's actually got dark pink shading. So its intermediate line is in bearish territory again on a weekly chart, so that's how significant that is. And the market sentiment line is now fallen out of its bullish, out of the upper reversal zone, and you can see the really weak bullish near-term peak. Very, very weak. It did not get into the reversal zone. It was very short-lived. We're all the way back there, and we're now 4% below the 30-week moving average. So, needless to say, the Russell 2000 obviously is not looking nearly as good as what we're seeing on some of the others. The Dow Jones especially is still, even on this chart, is by far more bullish. Though its intermediate line, you know, again, is kind of diverging with a peak that did not get back up above 80 here. And you can see its near-term line is also back out of the reversal zone. And we got a little bit of a long upper shadow last week that's relatively bearish. So it's not like the Dow is super bullish either, right? So definitely some bullish signs showing up here. Taking a look at the long-term charts, we did not get a red arrow. So we stayed bullish enough to not get a red arrow on this. We do have falling PPO, we do have a negative differential, but we're missing that red arrow that would make this a intermediate decline. The Nasdaq does have that, right? So we do have a good strong bearish candle here, no upper shadow. We do have a red arrow. We do have falling PPO. We do have a negative differential. In fact, that's the biggest negative differential that we've had since back over here. So pretty bearish there. The Russell 2000 also still has a red line, almost to a death cross here. The intermediate, the PPO is falling almost to zero, again death cross, and then negative differential with a bearish candle, no upper shadow. So the Nasdaq and Russell obviously looking a lot more bearish than what we're seeing on the S&P 500. Here's your Dow Jones, and you can see the Dow Jones, which had been so bullish, a little bit of a transition candle this week. Negative differential, no red arrow yet. And a slightly falling PPO, but after a couple bullish candles, just like that, we're back to a transition candle, very similar to what we saw in November here with that kind of candle coming after a bullish trend, transition candle, and then we had some weakness there. All right, let's take a look at some of these other oscillators on the chart. The S&P, you can see we're still below. We're not in bearish territory, but we're in the lower half of both of these charts for the S&P 500. The Nasdaq, same thing. We're not in bearish territory, but we are in the lower half of both these charts again. The Russell 2000, same thing. Not in bearish territory, but also below. So bearish territory for the CCI would be like getting below minus 150, bottoming out down there, minus 200 especially, and neither one of those are in those territories. From a directional movement standpoint, we are above 25 on the negative indicator, so that's really bearish. The positive is also, it's not below 20 yet, so it's not as bearish as it could be, but still getting that negative line as far up as it is a bearish sign for the S&P 500. The Qs, you can see the the positive indicator is almost below 20, and the negative is well above 25. And then IWM, we are easily above 25. The negative is below 20. That sets you up for another turn higher on the ADX, so potentially a new bearish leg lower on IWM. Of course, your diamonds, same thing. We are well above 25 on the negative. In fact, we never did get below over here 20. So that kind of, I mean, this was not nearly as bullish as that would suggest, because the negative didn't fall down like it did on when we normally are bullish. But being up above here, up above 25, especially up above 30, is relatively bearish, and so things are definitely getting a lot more volatile from these indicator standpoint. No trend right now in the S&P, no trend right now on the Qs either. Very noisy. IWM is the only one that has a weak bearish trend. We are below the blue line. The blue is below the green line. They're both below the cloud. So we are above 50, below -1. So we have a weak bearish trend right now going on IWM. And then diamonds is still actually on a bullish trend. So again, you can kind of see this kind of bifurcated market where your diamonds are really strong, your Nasdaq and your S&P are kind of noisy, and then your Russell 2000 still in bearish. It's actually in bearish mode. Let's take a look at the 3 green arrow chart. Here's all of our 3 red arrow signals. We have light pink shading here. We do not have light pink shading on the Qs because we have the green arrow on the stochastics. Light pink shading on the Russell. Light pink shading on the diamonds for the first time. So this is kind of joining the party. The histogram is getting bigger to the downside on the S&P and the diamonds. Not so much on IWM and not so much on the Qs. So kind of a mixed picture there. When you look at the 2-line version, the rally again. Remember, I repeat myself a lot because a lot of these patterns still show up. When you're below the 8-day moving average, you'll run back up to it, even on an intraday basis. So we don't really put a lot of stock into these rallies until we break back above these 8 and 17-day moving averages, and we're still not anywhere close to it on the SPY. On diamonds, we're not below it, above it either. In fact, we're flirting with the 50-day moving average and are below the 30-day. So we're still below the 17. We're still in bearish divergence mode on the diamonds, as the MACD down there is below its moving average. IWM easily in bearish divergence mode. MACD below its moving average. MACD is 0, below 0.2, and we're well below the 8-day. Again, and now you can probably start to see, like, oh, I can see why we rally, right? Because we are below the 8-day so far. And again, same thing here. And your MACD is below its moving average. We're below the 17-day. We're still in bearish divergence mode. So little tiny moves to the upside don't mean anything when we're in bearish divergence mode. Not until we get into bullish divergence mode, which would be the MACD above its moving average and the stock above its 17-day. And that's not the case for any of these major indexes. Let's take a look at today's intraday move. We actually gapped down, but we filled in the gap really quickly this morning and then went to our lows of the day. And then we rallied up on SPY above yesterday's low and right at last week's low. So, man, if we'd have finished down at the lows of the day, that would have been more bearish. And that was a good save by the end. The diamonds did not get up above yesterday's low point, but it did, and it did not get above last week's. At least it's still in the upper half of the chart. That's what it has going for it. The Qs did get above yesterday's low. It also got above last week's low point. We were a lot more bearish last week, not as bearish this week. So we did get above last week's low. We are obviously in the lower half of the chart. And then IWM also, in fact, this is going to end up being the 4-week low point in a couple of days. But IWM also got above yesterday's low point, did not get above last week's low, and you can see easily in the lower half of the chart too. So not the most bullish patterns here. In fact, when you look at the Arun indicator for all these indexes, IWM doesn't have a bearish one yet, right? So, but like I said, we're kind of in that mode. You can see the diamonds green line is falling below that 70th percentile. You can see once it starts to get below certain levels, whether it's the 50th percentile, the 60th percentile, that bullish territory, then a bearish crossover becomes more likely, right? You can see over here, you can see we actually got the bearish crossover with the just right after a high point. Those are a lot more rare when that happens. They tend to happen after the green line has dropped for a while, after we kind of pulled back from that high point. And that's kind of where we're at right now. We're flirting with getting below the 60th percentile, so it's not going to be in bullish territory anymore on that oscillator. The Qs, we are well below. In fact, we did have the 4-week, the bearish crossover there. If you look at IWM, and the bearish line is still in its bullish territory. IWM, you notice we are well below. Oops, sorry. There we go. We are below the 60th percentile. So again, setting up for a bearish Arun crossover again, where the red line crosses up, and if it crosses up, you can see over here. By the time we got the crossover, the green line was below 40. So we're setting up for that similar pattern right now, going into next week too. When you look at the today's volume, and remember, this is a doji pattern, right? So it's a very neutral day in terms of what the candlestick looks like. But we were above average in the volume, 95 million. The range was at 5 points, and there's no gap to, if it was 464.53, 465. So no gap to worry about. So we're just a little bit below the average, and it's a little bit above the average. And again, this is a day where we're below the 8-day moving average. When you're below the 8-day moving average, you should get bigger than average moves and bigger, much bigger than average volume, and that really pushes you through those 8 and 17 days. So when you get small ranges and small volume, relatively small volumes, and you're still below the 8-day by the time it's done, then you know that's not necessarily trend reversing, not nearly at all trend reversing. As you can see, both the averages here for volume and ATR are still relatively high. Not as high, you know, they're not at their 52-week highs, but the ATR pretty much is. It's really, really close. It's still well off the 2% mark at 1.3, where you start to say, okay, we're probably done with any kind of intermediate volatility or market sentiment decline. The VIX is really, really low too, so a big drop on the VIX got us into the lower half of bullish territory here. So oversold volatility going into next week, even if we are just barely below 20. So it's a low level for volatility. It's actually, again, sets you up for a potential rise in volatility going in. And there's always typically a rise in volatility on Monday. So let's see how far up it does go on Monday morning by the time the market opens up. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, click that thumbs up icon. That tells us two things. Number one, you liked our video today. Number two, that you want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch if you don't want to. Also, comment down there. What did you get out of the videos today? What stood out to you? What questions or comments do you have? Post those down in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. Click on this icon, this Market Outlook icon right here. That takes you to our Market Outlook live page. So I do a live video here every day on this page. I review all the trades that we've done in the old Market Outlook videos to see whether we should stay in them, get out of them. I also put on today's trade idea already before the market closed, so on Friday. So you can check that out here. You can see all the old archives. Every Monday, Wednesday, and Friday, just come to this page at 3:30 Eastern time, right before the market closes. Also, you can see our upcoming classes over here on the right. Click on View More. That takes you to this calendar. You can see all of our upcoming classes here, as well as all of our recordings. You can get to that also by clicking on Trading Rooms. You can also get to the Market Outlook Live by clicking on Live Trade Review right there in our menu. Come down here to the bottom, click on that heart icon that takes you to this page. Hit that like button. Also, click on the thumbs up icon here that takes you to this page, and hit that like button there. Again, the more you do that, it helps get our content out to more of our followers. And we're really trying to get like up to over 100 on these likes here. This one, this last video, I posted really late at night because I was coming home from a 3-hour-long basketball road trip. But let's see if over the weekend we can't get this number up to 100. And again, it helps us get our stuff out to all of our followers on these accounts. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. Now let's take a look at what's driving this price action here, and let's go to the comparison chart and just look at today alone. So we had quite the, it was quite the move, kind of multiple days here in one day. And by the time we got to the lows of the day, it was real estate was down, small cap stocks were way down compared to the Qs, long-term bonds were down, and then commodities were higher and the dollar was higher. So not exactly your combination. By the end of the day, the Qs rallied and finished the day really strong. IWM rallied and finished the day above SPY. Emerging markets and developed markets actually underperformed U.S. equities after outperforming them early in the day. Real estate off of its lows and outpaced long-term bonds. Long-term bonds held their lows, commodities held their highs, and the dollar also held its gains. Let's go to the week and see what it looked like, again going into the end of this week. And you can see, it was a real sharp sell-off here pretty much since the day started on Wednesday morning. We kind of started really as Thursday. These last 2 days have been some pretty significant selling from an equity standpoint Here's what Thursday and Friday look like. Again, and you can see the Qs were down 3% these 2 days. IWM is down 2.33%. And you can see the dollar stayed strong. It was down early yesterday, rallied today. Commodities were down big yesterday, rallied big today, and were flat for us. So you can kind of see how everything performed. In bonds, which were so strong yesterday, finished down today. So that's the 2 days by themselves. Going back out by the end of the week, emerging markets had a great week, relatively speaking. Commodities had a great week, relatively speaking. The gold had a great week, relatively speaking. So if I were to tell you those three things had the best week, then you would probably say, well, that means the dollar was down. Well, and you would be correct. For one of the first weeks we had in a while, the dollar was down. And this is a pretty significant move on the dollar. Let's go to this chart here. And let's go to the weekly chart to see the change. We had a really interesting technical analysis class where we talked about this gap. That's one of the biggest gaps that we've ever had. At least it is the biggest gap in the last 20 years. We've only had gaps slightly bigger than this, or right before the 1987 drop, and then in the late 90s we got up to, there's about 30% gap between the 50 and 200-day moving averages. We were like almost a 39% there. So, in both those instances, we filled in the gap between the orange dotted line and the blue dotted line. So, keep that in mind. And in the case of 1987, we filled in the gap in 2.5 weeks, a little more than 2 weeks. In the case of 1999, 2000, it took about 5 months, but we filled it once we broke the 17-week moving average. Now, again, we talked about the dollar. Remember, the euro is 60% of the dollar. So when you look at the euro, you're basically looking at the anti-dollar from a dollar index perspective. The MACD is above its moving average. Right? The price is now above its 8-week exponential moving average, and at one point in time was above the 17-week earlier before today's rally in the dollar. So that. You can see that the euro-US dollar is kind of trying to figure out whether it wants to, make another run to the upside. Over here, we never did really get the green arrow, just a brief little tiny smidgen above the moving average there, and it's a smidgen above the 17-day, and you can see 1 week later that failed. Little difference here. We're not above the 17 yet because of today's drop, but we are much further up above. And the stochastics is also, getting to where it's almost out of bearish territory. So it looks like the euro-US dollar is poised to make a different move. Small cap stocks, even with the late rally here today, is still easily below its 17-week. And you also notice it's also well below its 50-week. So we are in bearish divergence mode. And there's not very much volume below where we're at to fill in the gap to the 200-day moving average. You can see the diamonds has been the most bullish. They're still above their 8-week. The Qs, on the other hand, are below their 17-week last week and did not get back up above it today. All right, so we did get above the 30. We had opened below the 30 on Monday, but we rallied back up. We did get it back above the 8 at the highs of this week, but we pulled all the way back down to 17. So we are still in bearish divergence mode on the NASDAQ. And there's not a whole lot of volume here either. Now, you are still above the 50, so there's still some gap to fill in down to here. But you can see how wide the gap is on the Qs between the 50 and the 200-day moving average. Again, there's not very many other instances where we've been that big. Let me just kind of show you MSPPO here. To kind of give you an idea, so we'll go simple moving average, 50 and week and 200 week. To kind of give you an idea of just how how big this is. Let's go all the way back to 1990. Let's go back to 1980, since this real big, huge secular bull market started. Well, the Qs that's right. The Qs only go back to 99. Obviously, we're pretty bullish over there, and you can see we're at 45%. The gap between the 200. Let me see how far the NASDAQ composite goes back. Okay, it does go back to the 80s. So back the NASDAQ composite, which is more than just the NASDAQ 100, which is what the Qs is. That gap got to about 60%, 60+%. over there. And you can see again, once we started to fill in that gap, once we broke the 50-day in September, by the end of the year, 3 months, we had filled in that gap. And at that time that we broke it, there was a 63% difference, and we filled in the gap in a matter of 3 months, just like that, right? And remember, the bear market really didn't start until right around this area, so that's a very fast fill-in. And you can see over here in 2007, we filled in once we broke the 17 and the 50, we filled in the gap pretty quickly. At that point, we're at 15% difference. And then you can see coming over here in the COVID drop, we filled in the gap in a matter of, and the gap wasn't very big. It was only 20%, but we filled in that gap in the matter of 1, 2, 3, 4 weeks. Right, so that's a really, really big gap, and there's not a lot of volume here. We could, if we were to break down, and like I said, we're already below the 30. Getting below the 50 would be the next stage. Over here, the gap was about 27%, and we didn't quite fill in the gap, but we came really close. We weren't very far away by the low point of that Christmas Eve low point. So the fact that we are now below the 17-week moving average on the Qs, we are below the 8-week moving average on SPY right there. So we're below the 8-week. We were below the 17 at the end and again, you can see how wide that gap is between the 50 and the 200. And then, like I said, we are not only below the 17-week, but we have been below the 17-week. We have been below the 17-week for multiple weeks now, and we are way below the 50. Way below the 50. So, and you can see again, how fast can we fill in that gap? It might take weeks, a few weeks to a few months, but there is literally no volume holding us up. And we're at 29%, which is for the Russell 2000, going back as far as this index. Let's see how far. Yeah, the index goes back to 97, is one of the biggest ones. Again, we were at, in 2014, coming off of QE3. This is when QE3 ended. The gap was at 26%. You can see we didn't go anywhere once QE3 ended, and we filled in that gap eventually. Over here in 06, when the real estate bubble burst, we didn't go anywhere, and by the end of 07, we filled in that gap over there. So they were higher now than we were either of those instances, and there was just no volume right now, no volume holding us up above these pre-COVID highs. So, and we've seen how fast those things can fill. So pretty significant moves here. Long-term bonds. Long-term bonds had a big drop this week, dropping down, again, kind of filling in this gap between the 50 and the 200-day moving averages. We're still down. We dropped back below the 50 last week. We held that drop back below the 50. We're still holding that 200 week as we did in early part of 2021. Going into the end of the year, bonds rallied, even if the stock market stayed bullish. Bonds rallied there, so keep that in mind about TLT. Now here, that's on the weekly chart. Here's what it looks like on the daily chart. So we're still below that 8-day moving average and setting up a potential divergence here. A short-term, really short-term divergence. You can see the MACD got up to its moving average and dropped. So now the question is, if we were to get to 140 and test the low end of this value area, maybe even a little bit below that to that moving average, will the MACD get to a lower low at that point? Gold, you can see what gold's doing. It's still above its 8-day moving average and rising. That's on the daily chart. Here's the weekly candle. You can see we've been converging. We have all 4 of the 5 lines are all inside of this week's range, and we finished up. So it kind of gives you an idea of where we're at right now from a from gold standpoint. And then Bitcoin, Bitcoin here, you can see that it is down below, and we're just now getting a 200 week. It is down below its 50 week. Not a lot of volume down to the 200, breaking that 38% retracement level, Fibonacci retracement last week, holding that break so far, well below the 17. So we're in bearish divergence mode right now on Bitcoin, and potentially working our way back down to around 20,000, which is where that Fibonacci retracement line would be, and where the 200 week would be by the time we got down to that point. This is what the daily chart looks like. So we're just below the point of control in the daily chart, and potentially starting another death cross. So we had just a brief death cross here. It didn't last very long because we didn't stay below the 200 very long. Now we are. So it's very important to keep an eye out on Bitcoin for the next little bit. Commodities, you can see, are really strongly bullish up above the value area. Commodities typically are really bullish at the very end of bullish cycles and very beginning of bearish cycles. And this is a really strong bullish. You can see the MACD is just starting to cross back above its moving average this week. We're good bullish week here. I mean, commodities appear, in my opinion, to be going parabolic. And again, commodities go parabolic. That's not necessarily bullish markets. You can see we're not quite there yet on the daily chart. But when you look at the weekly chart here, you can see the positive is starting to cross the positive indicator, which had gone really bullish coming off of those lows. You can see the ADX, the positive indicator, is making another run up above 25 again. Very, very bullish sign. Let me go back and show you that 2008 run. So here's that 2008 parabolic move that it made, coming off of what, 25 back then, and making a run up to almost 50 from July of 07 all the way up. So that's the kind of move that we need to kind of be a little concerned about, because that's not necessarily a strong bullish market move, right? That's okay because we're coming off of extreme lows. Not so okay when you're moving up higher here. Something also to keep in mind too about the S&P and the NASDAQ composite, when you look at their long-term chart trends, on the 1-year chart you can see we're not so high, but look at the 10-year. We're still easily above the first standard deviation channel. The Qs are also still above their first standard deviation channel. IWM is at least in the upper half. Now keep in mind that we're about to end QE, right? We're tapering. We're about to end it. So usually QE would be to get you from extreme lows from a trend standpoint to back to normal. Now, but if you look at right now the S&P 500 over the last 10 years is on a trend line that's about what, 25% a year annualized return, and we are 1 standard deviation above that, and we're about to end QE. Let me show you back in 2014. So let's go back to October of 2014. So like the middle of the month there, about when QE3 ended. So we'll go back to 10 years before that, to 2004. This is when QE3 ended. So it's kind of more at the beginning of the month here. But this is when QE3 ended. Again, it ended. The trend line wasn't as bullish. It was on a 4% a year run. So not so bad. I mean, QE3 staved off a really bearish trend. We were well below the 10-year cycle there, and in fact, if you were to take a look at March of 2009, 10 years before that, 2015 to 1999, we were well below. The 10-year trend was flat at best. It was actually down. The 10-year trend was down. We were way below that trend. So QE made sense to come off of that, and shoot, by the time we got to the end of 2013, so right about, I don't know what, let's say like November, the middle of November, right when QE3, excuse me, 2012, right when QE3 started, we were roughly, we had a positive trend. Right, we had a positive trend. We were at 1% annualized over a 10-year period. We were just getting off of these extreme lows back to kind of the middle of this trend, again, of a flat trend, right? So QE3 did its purpose. By the time we ended, again, QE3, go back to the beginning of the month here. By the time we ended QE3 in 2004, by the time we ended QE3, we had a good bullish trend line. 4% a year. So it was better than when we started. We had gone from about 1% a year to 4% a year. And we were well up. We were just barely above the trend line when it started. We were a standard deviation above it when it ended. So it kind of did its purpose. It kind of got some investor sentiment going again. Now just remember those really small negative or single digits, 4%. Now just remember that if I go out to now the end of QE4, so just right now, we are over one standard deviation above a 25%, only 25% 10-year annualized return at the end of QE. Not at the, like this is like, we don't have interest rates right now at really like strong returns. We have an inverted yield curve because the Fed's raising rates. That's where we were in the late 90s when we were in a very similar situation. We are ending extremely accommodative monetary policy in this environment. So that kind of gives you an idea like what to expect going forward. Doesn't mean we have to be bearish, but it's going to be hard to be 25% a year over 10 years bullish and above one standard deviation when you don't have extremely accommodative monetary policy going forward as soon as March, right? As soon as March. So keep that in mind about, again, QE3, we were still behind the 8 ball. We were just barely starting a long-term bullish trend. We were just barely above that trend line. By the time we started, we were better by the time we ended. We had gone from 1% to 4% 10-year linear regression. Now we're at 25%. Now we're well above one standard deviation above, and we're just ending extremely probably outside of 2009 the biggest accommodative combination of monetary and fiscal policy that we've seen. Again, obviously the 1929 and all of that, but since the S&P 500 came into existence in the late 50s, outside of 2009, March 2009, this may have been the biggest combination of monetary and fiscal accommodative policies ever. And 2009, we were coming off an extreme low with a 10-year trend line, regression trend line that was flat at best. It was actually down. Here, we are ending it, and we have an extremely bullish trend line, and we are well up above it, not 2 standard deviations below it. So, again, and here at COVID, you say, well, what were we like here at that COVID level? Well, at the COVID level, when we started this accommodative policies, let's I can't remember exactly when it started the climb, but let's take a look at what it looked like there. Maybe 2010, and this one would be 2020. This is what it looked like there at the COVID. We were 2 standard deviations below the trend line, which sounds really bad, but remember that the trend line, or the 10-year trend line, was up 20% a year. So not nearly that bad. Not really that, and that sparked, right, a very similar accommodative policy response. This sparked a very similar accommodative policy response to what we saw here. To what we saw here. 2 standard deviations below, a flat at best, not 20% a year upside, but flat at best, right? That sparked a similar response from a fiscal and monetary combination. So not that I'm like saying that the markets are manipulated or anything like that. I'm just saying is we've been very bullish over the last few years because of the policies that we've had in what already was a very bullish market. So, when we start to drop from these current levels, keep in mind that we're not necessarily dropping from fair value, and eventually we'll bounce back up to fair value. We're bouncing up from excessively bullish values. We're dropping, from excessively bullish values. So we may be starting to drop back down to fair value. That can impact, our investor sentiment going forward here over the next so many months or a year or two. All right, now let's take a look at our trade idea for today. We'll go to Spotify. There we go, Spotify. Oops, nope. There we go. Obviously, we have a bearish pattern here, like dark pink shading, red line. The intermediate line had gotten just barely above the 40th percentile. We're already back down below 40. The bearish, we had this kind of bearish near-term peak, back down to oversold levels, and intermediate lines dropping down. We're over 6% or almost 6% below the 30-day moving average. If you look at the chart here, you can see we had a bearish candle this week, a little bit of an upper shadow, but you can see we have a death cross forming, a pretty decently sized differential. We have the red arrow still, no green arrow, falling PPO. If you take a look at the 3 green arrow chart, you can see we have a two red arrows, but the MACD is starting to pick up again. This is what it looks like when you look at the 2-line version of the chart. We are back below the point of control on the 1-year basis, flirting with breaking below the bottom of the value area. We're below the 8 and 17-day moving averages. They're both diverging now away. See, we're in bearish divergence mode again. The 50-day is just barely crossing the 200-day moving average. So we did actually have a small golden cross on this pullback, but we stayed below the 200 this whole time. Looking like we're potentially making a new leg lower here. If you look at the DMI, you can see we're breaking back above 25. We're already below 20 on the positive. The ADX is low, so it's actually setting up again, like I said, for potentially a new leg lower. We're back below 40, back below minus 150 on the CCI, so it looks like we're breaking down on those charts. We're easily below the cloud. We had a bearish trend going. We consolidated it. Now maybe starting a new trend to the downside. You can see from the Bollinger Band standpoint, we were breaking. It looks like we did actually finish. Excuse me. We actually did finish below the lower band just barely. With a very low bandwidth. So, and the bands are inside the Keltner channels. When you look at the bands here, they're inside the Keltner. So we're setting up for a bearish breakdown there on SPY on spot. So what I did for our trade then is I went into let's see here, we need to go to the market outlook. I went to the February option and I bought the 220 put and I sold the 210. So you can see here, here let's go to the Analyze tab. If you can see here, it's basically a 1-for-1, 1-to-1 risk-reward ratio on a worst case scenario. The best, and we're down just a little bit since we got in. Obviously, if we go up to about 240 or so, then I can get out with half of that loss. And be able to take and then be like done with the trade. Obviously, I wouldn't stay in it to continue losing. Obviously, if we get above 241, that's getting it back above these highs. So it'd be like completely reversing this near-term reversal, getting up to a new near-term high. We would be diverging to the upside. We'd have a bullish divergence going on, and we can close out that trade and be done with it. So, it's a quick and easy trade, and like I said, at worst case scenario, I have a 1-to-1 risk reward. More than likely, I have about a 2-to-1 reward to risk ratio, knowing that I most likely won't lose any more than $250. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's threads. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as our website at marketscholars.com. Click on that thumbs up icon. Like us on Twitter and Facebook too. Comment on the video. Have a great rest of your weekend, everybody, and a great holiday weekend, and we'll see you all next time.